Okay, I'm just confirming that you can all see me. How's this all going? Guido, can you see me good? Okay, okay. All right, ladies and gentlemen, thank you for joining us today. I hope you can hear me loud and clear. I hope the sound picture is all good. We're in lockdown here in Melbourne, as most of, well, quite a lot of Australia is. All right, ladies and gentlemen, thank you for goes wrong with the camera. I hope you can hear me loud please, and clear. You have to bear with me. I'll probably go to the other, the integrated camera. I can see that one person's already given us the thumbs down, so hopefully that's not a sign of things to come. If you do find yourself liking this, do give it a thumbs up, though. Hopefully it will give it a traction and do this more often going forward. Look, I mean, it's been a tough week for gold longs. I'm going to have a quick look at the traction. Do this more often going forward. Look, I mean, it's been a tough. Okay, you can see here the performance of gold over the last 5 days. I mean, yeah, obviously everyone's focused on what happened on Monday, but you can see here over the last. Okay, you can see here the performance of gold. Yeah, you can see here feedback delay. So enjoy what you can see here over the last. Okay, you can see here the. Yeah, there's something wrong with the sound. You can see here feedback delay. What's going on there? Okay, you can see here the. Yeah, there's something. Yeah, there's a problem with the sound. You can see here. What's going on there? Okay, you can see here the. Bear me 2 seconds. Okay, this is the sound's not very good on this stage. Okay, this is the sound's not very good on this stage. Sorry, people, you might have to just bear with me a second. Yeah, so I apologise to this, everyone. I'm not really too sure what the. How's that? Is that sounding better? No. Sounds like crickets. Yeah, I apologise to this, everyone. I'm not really too sure what. How's that? Go for reset. No. Sounds like crickets. Yeah, I apologise to this, everyone. I'm not really too sure. How's that? Go for reset. Yeah, it's totally. Does that sound any better at all? I can hear the music in the background going on loop. The need for tweed. Yeah, it's totally. Does that sound any better at all? Yeah, it's. I can hear feedback. Hear the music in the background going on loop. The need for tweed. No, but it's feedback into my microphone. Does that sound any better at all? Yeah, it's. I can hear feedback. The music in the background going on loop. Yep. The need for tweed. It's feedback. Does that sound any better at all? Yeah, it's. I can hear. Oh, mate, this. Okay, I'm getting feedback into my headphone, but I think everyone can hear me. Okay. Sorry, are we still feedback, Rod? All right. Okay, I'm getting feedback into my headphone, but I think everyone can hear me. Okay. Sorry, are we still loop madness? Rod? Okay, we might have to cancel this one and then redo it again tomorrow. I'm not sure what I'm doing. Loop madness. There are multiple sessions running, lots of echoes. And then redo it again tomorrow. I'm not sure what I'm doing. There are multiple sessions running. Okay, I'll just shut YouTube. Yeah. Does that sound better? Hang on. Are we working better now? Yeah. I reckon you're good. Okay. I can't see any feedback at the moment. That's the only problem. I'll type it through to Slack. All right, I'm gonna go. Can you have a look at the comments? It's just making sure everyone else in the room's good to go. Okay. You just tell me if everyone else is hearing this okay. I can't see any feedback now. Okay, just doing a quick test. Okay, perfect. I think after that we may be cooking with gas. So apologies if we've lost half the crowd. That was a bit of a kerfuffle. We'll put that down to teething issues with our first one. I am going to crack on though, so apologies for that, and hopefully it's all good to go from now on. Right, okay, so what we're going to look at first of all is how gold's performed over the last 5 days. And you can see here on the Bloomberg chart that you can see gold is down 2.9%. We can see silver having a slightly worse performer, down 6.8%. We've got platinum actually doing quite well at 1.3%. It's had a nice rebound off those lows, and palladium also down smalls. So it's obviously been a pretty tough time. But if we have a look at the moves intraday, I'm just going to sort of just take myself a little bit down here just to make so you can see really the moves that we've been seeing. But obviously everyone's cast their mind back to where we were on Friday. And if I actually take this back a little bit further, you can see that gold, you can see here on Friday, this is payrolls. We talked about this last week, about the influence that payrolls could have on the gold market. Now, I think what was really interesting, and we've sort of taken, I was sort of covering old ground, but it will be important as we look ahead. And you can see here that when we got this, it was an incredibly strong payrolls number. The next payrolls number comes up on the 3rd of September, and that could nail a September taper from the Federal Reserve. I think we probably will do. I think that September, the Fed meeting that we see there, we will see a formal announcement that it's coming, and it may start in November. The question is will it actually be a volatility event for markets? But you can see the gold price here in US dollars. As soon as that payrolls number came out, we saw it pretty much collapsing into the close. Now, of course, on Monday, we had a situation where Asia had a chance to react. Now, because gold was already falling, I think a lot of what we saw was commodity trading advisors, which are effectively trend following funds, and also leveraged accounts who probably would have been under a bit of pressure. And as the price came on, opened up and traded a little bit lower in spot gold, you saw this point where it just cracked and cratered. And I've heard all these different types of situations playing through on social media, that it's bullion bank manipulation and all these other factors. To me, that's absolute nonsense. What actually happened for me was that we saw CTAs closing out and we saw leveraged long positions getting absolutely taken to the cleaners. There was a big margin call, there was a squeeze, a liquidation, of forced selling, which of course is why we saw this coming through. We had some holidays coming through in Asia, and we saw very poor liquidity playing through in markets. So this really was a forced sale that came through in the market. Now, to anyone who didn't have a long position and wasn't caught up in that stop loss run, you were licking your lips. This is what trading is all about. This is 101 flow. And really what we saw is this absolute collapse in price coming down into these low levels here. And I came out on Twitter, and I'm not going to give myself a pat on the back because I didn't actually trade it myself. But we were looking at a situation where we're saying, wait for that flow to go, wait for that forced liquidation to go, because when it does, you're going to see a lot of people coming back in and starting buying gold. And of course, that's what we did. We could see it sort of settling down into 1690, and then we saw this strong bid coming back in. Now it was oversold, but you can see there's two very clear levels that we're looking for in the short term, and that is 1755. 1756, which is the liquidation point. Liquidation points don't necessarily give you sort of clear turning points in markets because they are very much artificial in nature. It's not where everyone sort of reacted to a situation, which is where we go up to an 1800. 1800 obviously being a round number. Round numbers do come into play from time to time, but 1800 is also the non-farm payrolls high when we got that number there as well. So that is a psychologically important level, not just because it's 1800, but also because this is the non-farm payrolls high before we got that really strong piece of information that really solidified the idea that we're going to get a number, that we're going to get a tapering exercise playing through. And actually what you guys should realize is the conversation has moved on from the Fed tapering its balance sheet. Remember, these guys are buying 120 billion of mortgage backs in US Treasuries each month, and they'll pull that back gently. The bigger question that we need to ask, and where asset prices are going to move, where Treasuries are going to move, where the dollar's going to move, where gold, the second derivative, is going to move as well, is more about the pace of tapering. When does that QE program come back down to zero, so they're no longer buying any bonds? That's really important for the bond market, and in essence, the gold market as well. Why is that? Because the pace will lead to changes in the supply of duration in fixed income and the amount of bonds that the private sector are going to have to buy in 2022. So what we need to really think about, it's not just the date when they're going to start tapering, but more importantly for the gold market is going to be when they're going to finish. The pace of that tapering exercise is so much more important. The other issue is when we get the September meeting playing through, is what are the dot plot projections going to be? The Federal Reserve will not just look at where their calls are for 2022, 23 in terms of the Fed funds rate, but also for 24 for the first time ever as well. So that's really, really important for the market. Okay, let's have a look at the gold in US dollar price. We talked about this last week. We said that there's probably some downside risk. I had not been expecting the magnitude there. I said that we were looking to the options break-even rates, which were down at 1777, and we said around these kind of levels, there's about a 68% probability based on options. The fact it's just one standard deviation, that we'll probably look for people to buy into these levels here as well. Of course, this is why options traders buy and sell volatility, because when obviously they can come up with a view about what's going to happen, but if that's wrong, you can see some pretty explosive moves. And that's of course when we sort of traded through this range low around 1795. It took us through the options barriers, and then you saw this capitulation move coming down here as well. So it really didn't mean too much. But so that I think we kind of got the direction right, but we didn't get the magnitude of the move right. Obviously we hadn't been expecting to see this move down to these levels here. So I'm very welcomed. Certainly, if we go back to the Bloomberg charts here, you can see the extent of the movement that we've been seeing. A lot of statistical guys will look at realized volatility or implied volatility. I think one of the best things that we can do when we're looking at movement is conceptualize the daily range as a percentage. Why do I use range? Well, because as traders, we're involved in the gold market 24 hours a day. We're not involved in it on a close-to-close basis, which is what realized volatility and statistical volatility captures. We're looking at the high, subtracting the low, and we're looking at that as a percentage of the previous day's close to give us an understanding of the range. So what I've got here is a chart which looks at that, and you can see on that Monday, you can see that the range high to low is 4.2%. We've come back a little bit here, but you can see the 5-day moving average of that period has picked up really to the highest level since June, and one of the highest levels that we've really seen for quite some time. And you can see here over the last year that move on Friday that we saw on Monday was actually a 3 standard deviation move. So these are very rare occurrences to see that kind of move relative to where we've been. So that kind of hit us and smacked us in the chops. You know, we're not used to this sort of volatility in the gold market. We've seen very tidy ranges playing through, and then suddenly just bang, this explosive move came out of what was effectively nowhere, because we've been seeing these such sleepy conditions. And if you're trading gold, if you're trading any market, you have to adapt to changes that are happening in the rhythm and the structure and the volatility. Volatility in markets for me is the most important trading concept, bar none. It affects the direction of where we trade. It affects the assets we trade. It affects our risk management, how much risk we're taking on in a position. It affects, therefore, our position sizing and position sizing relative to the size of our account. So volatility is the only true asset class, and it is effectively the most important part and variable of our trading. And we saw this move here, 4.2%. It was big. It was quite aggressive. And now what we've actually seen is that move back up into the pre-liquidation levels there as well. So we're testing that now. If we can get a break of this level, then I think that's going to be very important indeed. So 1755, why else is that important? Well, we've got this 5-day exponential moving average playing through. And when this starts to trend, I really like to look at the exponential moving average. If that starts to trend lower, you tend to see price moving up into that average, people looking to sort of accumulate shorts, and then it starts rolling over, and that's when you can trade with that. So it's a really big move now. We've traded much lower. It's obviously very, very oversold conditions. We saw this big sort of pin bar coming through, indecision playing through in the doji. The bulls have grabbed control. Now it's a really, really important session ahead of us. Can price break through this 70.55 5-day exponential moving average, or will it roll over? So it's make or break trading ahead of us at the moment. Not only that, but we've also got that liquidation level that we talked about. If we can break through 17.55 and above 17.64, which was the high that we saw on Monday, then we can probably make a move back up into this range of 17.98 into this the former range. I think that would be probably where we'd be looking, maybe 17.75 with about a 70% level of confidence. But it's a really big make or break session now. If we look at the option straddle pricing and where the break even levels are, they're saying with a 68.2% level of confidence that over the next week we should trade up to 17.76 or down to 17.23. So that's the range that the options traders are going to take. That's the expected move displayed by options pricing at the moment. But I think if we do roll over from here, which is the liquidation level and also the 5-day moving average, if this starts to trade lower, and if we can come into our 1-hour chart, this is why we look at in slightly lower time frames, we can see we're at these key levels. If this starts rolling over now, I would go along for the ride, and I'd be looking to accumulate short positions, and I'd be looking for that to trade down into 17.23, where I'd regain and have a look at and take some composure. But you can see down at these lows, that would be an obvious level where we might see some bids playing through. But this 5-day exponential moving average is key now. So if we can break through that to the upside, through those liquidation levels, then I think we probably make a move back up to 17.76. Maybe at a push, we can get up and back into this former low 17.98. So again, that's a really, really key situation to play through. The question we always ask ourselves is, it's not just about the gold price, but we can also look at trading this in alternative currencies. It's something I talked about last week. There's quite a few people coming out and saying, yeah, it's quite an interesting concept. But if I'm taking long positions, do I want to do it in the US dollar, or do I want to do it in the yen, the euro, the Aussie dollar, the pound? And I do that in what I believe is going to be the weakest currency. Now, the concern that you have for that is that you're becoming a double trader. I'm trading gold and I'm trading currencies, and trading currencies in itself can be quite difficult. I'm a currency trader. I know it is difficult. But if you can get that right, then you can get more bang for your buck, effectively. You can max out the trade by not just getting the gold price right, but also getting the currency effect as well. So at Pepperstone, we offer different gold in different currencies. And so we've got to take a view then, if we think gold's going to go up, if we like the fact that it's going to go through this 5-day exponential moving average, if it goes through those liquidation levels we saw from Monday, 17.55, Then we move back up into 1776. Do we want to do that in US dollars? We want to do it in the weakest currency. If we're doing it in the weakest currency, you want to be you're long in the weakest currency, you're short in the strongest currency. So that's the thing we're looking at the moment. So let's have a quick look at the currency markets. Let's have a look at what's going on in the dollar, because this is really interesting. Okay, the dollar index, which represents mostly the euro, there's about a 57% weight towards the euro in this basket of currencies traded against the US dollar. James, I'm going to crack on with your question in 2 seconds, buddy, but we're going to have a look at the dollar index. Now, the interesting thing here is that after the CPI numbers yesterday, and more importantly, the Treasury auction, the 10-year Treasury auction last night was one of the best auctions that I think I've ever seen. Well, we've seen for a long period of time. Foreigners were just piling into duration assets in a big way. That caused yields to move a little bit lower. Are we ready to start seeing yields move lower, or are they going to continue to move higher? Yeah, that's the question we're going to be asking. But look at the performance of the dollar here. Traded to new highs. The bears wrestled control. We traded lower. We closed low through the previous day's low. Bearish outside day reversal, holding the 5-day exponential moving average. Now what we want to see is, are we going to see the follow-through selling playing through? So if this kicks through the 92.79, that's a momentum short. The dollar's going to go down. Probably more so against the Japanese yen and against some of the other currencies. The euro doesn't look particularly attractive as a currency right now. But if we can trade through these lows, then I think that if we're going to go long, if I'm going to go long gold, then I probably want to do it in dollars. But I also want to keep an eye on that. I'm going to have a little radar, and I'm going to keep an eye through these lows here. And if gold starts kicking up through 1755, and I see the dollar moving up or moving down through these levels here, that's going to be a really aggressive signal for me, and I'm going to be looking to go long gold in US dollar terms, which of course is what most people do anyway. But you can see here we're just toying with that idea, and again just going for 1776. Let's have a look at gold in Japanese yen terms. Now, if we're looking to go short, if gold prices roll over, let's have a look at that dollar yen trade that we've been seeing. Where is my dollar yen? I can't see it. I'm being completely blind, but that's okay because we can just type it in here. Again, there's nothing really to it. We've got a wave of supply that's come into dollar yen. Again, if this kicks lower here through these lows, 110.30, yeah, that could be an interesting trade, especially if it can close through the 5-day exponential and that starts heading a little bit lower. If gold prices are going to go lower, and remember, we want to be selling gold in the strongest currency, then I would probably look at this cross, because I think it may coincide with a sort of a risk-off dynamic playing through. What's the best currency to trade in a risk-off dynamic? The Japanese yen. I won't go into the reasons why. We'll be here for a while, but I want to go back to that gold in yen terms. Again, we're pushing the 5-day exponential moving average. We've had a nice move off this indecision move. It's a make or break stage. There's no really clear stage. Now, again, we can go into lower time frames and we can trade this off 15, 30, 1-hour charts. But if I'm looking at the daily chart for oversight, it's kind of in this no man's land at the moment. We've got these series of lows which came in. We could probably bring that a little bit lower there. But you can see we're in this kind of make or break zone again for gold in Japanese yen terms. This is a really interesting one, because if gold does roll over here, and again, we can take it into a lower time frame just to see the reaction of the market rather than using a daily chart. But if we actually see this start rolling over off this 5-day exponential moving average and it gathers momentum, we can see the oscillators moving to the downside, and we start seeing volatility kick up in broad markets. Maybe we see a little bit of a downdraft in the S&P. Then I think gold in Japanese yen will probably be one of the better places to apply those shorts. You're not only getting the gold price depreciation, but you're also getting that yen kicker as well. I think that's an interesting one to look at. So again, we're looking for that currency term to play through. So I think that would be an interesting trade to look at. But again, just looking at that setup, we're in this kind of no man's land. We're waiting for the market to reveal itself. We've got our levels, we've got our playbooks, and we're just waiting for the market to say, Chris, come and grab me. I want to go long, I want to go short. As a trader, one of the most important things you can have is an open mind. You can be an investor and love gold and be a gold bug all you like, but when you're trading the flow of capital, you're trading price action, the aggregation of behaviors that are playing through in markets at any one time. You do not fall in love with a trade. People who fall in love as a trader with a position will get burnt. and you need to take that loss quickly. You need to understand what the market's telling you and react. It's not about prophesizing, it's about reacting. And I think that's really important, the difference between trading and investing. You do not fall in love with the trade. James, Benjamin, nice to see you, James. Interesting to think that historical volatility tends to cluster, low with low, high with high. Yeah, it's a good one. I really want to do some back testing on a lot of this stuff. I put out a piece not about the gold market specifically, but about this idea of never shorting a dull market, and I used 10-day realized volatility in the S&P, and I asked the system, if I buy the S&P when realized volatility in the S&P comes below 5%, which is ridiculously low, does that the fact that we get realized volatility in the S&P so low, is that a precursor for higher volatility? Well, I tried to make sense of this statement that you don't go short a market, you never go short a dull market. Well, since 2000, the year 2000, if you had bought the S&P when historical volatility fell below 5%, you would have made money 60% of the time over the next 5 days, and we've used the calendar outcome to see that. So actually, the idea of never shorting a dull market, if we're just using S&P futures, actually is true. I haven't done it on gold and see how that performs. But I want to have a look at this chart here because I think it's really interesting. We're going back to our good old friend, the options market. The options market can tell us so much about sentiment. I mean, we can look at positioning as well, and I've got here net long positions held by managed money, and again we've got 107,000 net long contracts held by the market. After this is of last Tuesday, so obviously given that liquidation that we saw on Monday, I would imagine that positioning would probably be a little bit lower at the moment, probably closer towards 50,000 or so. But the market has been long of gold, and certainly the leveraged funds were pretty long of gold, and I think that's probably taken a bit of a battering after what we saw last week. But if you have a look at sentiment in the options market, what we're looking at is 1 week risk reversals and 1 month risk reversal. Now, so people who have never heard about this world, what we're looking at is the idea about the market's perception of movement. And what we're doing is we're taking 1 week call volatility, implied volatility, and we're subtracting 1 week put volatility. So puts obviously protect you on downside, and calls mean that you're expecting greater movement to the upside. So it's a play on relative movement. Now, what we can see here is that the call volatility or put volatility is trading at a 1.5 vol premium to calls. So the market is saying to me that over the next week, if we're going to see a move, the bigger move is going to be to the downside. People have been paying up for put protection, 1 week put protection. The question is it at an extremity? Now, if we got below sort of 3.5, I would say that the sentiment in the gold market is too bearish, and people have been, relative buyers of put protection. But you can see at the moment there's a 1.5 vol premium for put protection over calls, which tells me that if the options traders are saying if we're going to see a move, it's going to be bigger to the downside and more aggressive to the downside and to the upside. And over the coming month, if we look at 1 month relative volatility, you can see that again, it's not at extremes. That's what we're looking for, is this level at extremes. But you can see that the market is betting that if we're going to see a move over the coming month, it's going to be more pronounced to the downside than it is to the upside. But we're looking for those sentiments where it's as extremes as well. What about gold in Aussie dollar terms? That's a good question. Let's have first. I guess for the first one we're going to do is have a look at. Let's just take a look. Let's have a quick butchers at the Aussie dollar price. This is something we looked at last week because we've got this big level of resistance at the moment. We obviously came down in the Aussie dollar terms. You can see that we made this double top here. We broke down. We're making lower lows, lower highs. And now we're in this period of consolidation. Market doesn't know what to do. Are we going to buy the Aussie dollar? Well, we can't really. We're fading it into 74.15. We're happy to sell. We're happy sellers there as well. But we didn't get a bullish outside day yesterday, but we got a higher high. And that means, there's a possibility that we could squeeze back into the top end of the range. But if I'm taking positions on gold and I like it on the short side, then we're going to get a bit more infused about using the Aussie dollar as a weapon to trade gold from the short side when we can see the Aussie dollar break through here. Now, there's so much negative news about the Australian dollar at the moment. China are continuing. We've seen news today. We've seen China continue to come out and talk about curbing activity around the IPOs and certain companies that are not doing the right thing. You know, we're going to start looking ahead to the Beijing Winter Olympics. We're going to do a lot of work about that here at Pepperstone. And they've already talked about cutting steel output because pollution. They want the skies as clean as possible for the Winter Olympics. That's already having an impact on iron ore prices. Is that correlation with the Aussie dollar going to start ramping up? Is iron ore going to start trending significantly lower? Is the Aussie dollar going to take that from the terms of trade? It's interesting though, because if you look at actually the price aggregation of flow, then you can see that, you know, it's sort of just holding in, it's trading sideways. So again, this is one that if I was trading the Aussie dollar, I'd be looking to just you trade the ranges at the moment until price can actually start trending a bit better. If you are a mean reversion trader or you like to trade a range, this looks like a really good range trading sort of candidate at the moment. But when it starts breaking out, starts trending again, then we can start using the Australian dollar as a vehicle to trade Aussie dollar gold, XAUAUD. But at the moment, it's not really doing a huge amount. I'd probably prefer to use the Japanese yen or the US dollar as we'd always do. But have a look at gold in Aussie dollar terms. Again, not too dissimilar from what we saw in the US dollar, where we saw this massive rejection of those. Look at this huge bid that came back into the market, indecision. Higher low, bulls took control. We're back at this 5-day exponential moving average. We don't have that series of lows like we saw in the Japanese yen gold. But yeah, again, it's make or break time. So, if we were to see a slightly weaker Aussie dollar coming back into the bottom of that range that we just talked about, then gold prices might squeeze up a little bit higher. But yeah, it's not doing a lot really, is it? The Aussie dollar gold. So we're just having a look back at this one. We're back at that make or break time. I think that's the interesting one to look at. So the options market is telling us that if we're going to see a move, the market's saying that we're probably going to see a much more pronounced move to the downside. So there's still looking at that. Let's have a look at the bond market. Again, we come back to our old good friend real yields, and you can see that real yields had a little bit of a stage of a rally, and what we're looking here is Treasury inflation protected securities or TIPS effectively. So they're nominal treasuries adjusted for inflation expectations or break evens. You can see a situation here where it started moving up. Everyone got really excited, including myself, that we're going to start seeing bond markets sell off into this formal announcement from the Federal Reserve. But then look, it started to roll over again. Now gold prices, which I've inverted here, so you can see that gold prices are actually going down in this situation, not going up. I've tried to look at the relationship that you can see was quite strong for a period of time. They're not really showing a huge amount of correlation between the two. They did last night, actually. We saw real yields moving down and gold prices having a nice move up. So I wouldn't count this out, but the relationship at the moment statistically is not brilliant. But what I am looking at, though, is the Fed funds rate. And I think this is going to be something that we're going to look at much more closely and talk to clients much more closely about in the next month or so ahead, especially as we go into the September Fed meeting. For me, this is the most important thing for markets now. This idea that inflation is still pretty sticky. It's not really causing us any troubles. But it's enough to keep the Federal Reserve keeping their eyes on normalizing policy. The labor market in the US is going to continue to be very, very strong, and it's their preference at the moment. If you have a look at here at what's priced into the US interest rate markets, you can see the purple line is for what's priced in for 2024. The yellow line is the amount of rate hikes that are priced in for 2023. And then for next year as well. But we're really specifically looking at what's priced in for 23 and 24. And are they going to start moving up again? If these start moving up and the market pricing in a greater degree of rate hikes, I think that you're going to see bond yields sell off, especially sort of the 5 to 7 year bonds. I think real yields will start going up. And I think that's when gold will probably struggle and we'll start making a move back down to that situation that we talked about there as well. So, I think this is really important. So everyone's talking about this idea that the Fed are going to taper. What's more important is the reaction in interest rates. This is where the dollar is going to key off. This is where gold's going to key off. And this is why we look at the Fed funds or euro dollar future, which you can see on TradingView. And also the pace of tapering. I think that's the most situation. Tony, I'm currently in gold US dollars from 1730. I'm considering closing it at this point, as I'm sure which way the price will break. Well, do you know what? I'm not going to comment on your individual position because everything that we say today is general advice. I can't give personal advice, unfortunately, but that's the framework. So I can't tell you what you need to do with your position. I've pretty much laid out what I'm going to be doing or what I'm considering doing, but I can't comment on your individual position as such. But yeah, I think we're in this kind of, for me personally and my own thought processes, we are in this kind of make or break situation. The market needs to reveal itself. If we do see markets roll over from this 1755 level, which of course, as I talked about earlier, is also this level here, which is the liquidation point that we got through on Monday. I think that could be really, really powerful indeed. And I think we'll probably make a move back down into those lows. If it breaks through there, then there's a pretty good chance that we continue to squeeze back up, back into 1795, 17, maybe even 1800. So that's the way that I'm going to be playing that personally. But yeah, I can't comment on your individual position. Another question for Hussein. What about the silver market? Very correlated to gold at the market. Now, I'm glad you brought that up, Hassan, because yeah, if we go back to that Bloomberg chart that we talked about earlier, silver got smashed. I mean, look, silver is gold's high beta brother, effectively. So you see a situation where gold prices go down 1%, silver prices tend to go down 2.5%. So it really is. I mean, with silver, I know everyone talks about this idea that it's got an industrial uses and you can use it for other factors. But for me, as a speculative vehicle, if you've got a higher risk tolerance and you're prepared to get that greater percentage move, obviously liquidity is a major factor. But if you've got a higher risk tolerance and you've got your risk management set up, you're going to see a bigger move in silver, and that may be something that you want to consider. For me personally, and the flows that we see, generally most people play US dollar gold over silver. But if you're going to take a view on silver and gold, they're pretty much going to do the same things with different degrees of movement. It's what we call beta. So silver generally has a higher beta move relative to gold. But this is an interesting one as well. It's just another one where you can see that we obviously had that big move down, very, very aggressive. It's down 6.7% over the last 5 days, but it was down a lot more, and we've seen some buyers coming in here. Now, if you take that down into the hourly chart, you can see that much more readily. Again, we're in this tight range. The market has found a short-term fair value. This is what we're seeing. We're seeing disagreements. The bulls are saying, I'm not prepared to push this one higher. We would love to see it higher, but we don't have the conviction to add to these positions. And the sellers at the same time are saying, well, we're going to sell into this, but we don't really have a huge amount of conviction either. So the market's got this point of disagreement. Let's call it a fair value. Again, when this reveals itself, that's when we're going to see an explosive move. Which way is it going to go? I have no idea. But when it does, then you join the ride. That's the way that I'd be looking at this right now. And it's had this point down. Now it's trading sideways. The market needs to push us. So what we do is we put this on the watch list. When it starts to move, and if it builds momentum, then we'll add to those long positions. We'll add to short positions. If something's working, you do more of it. If something's not working, you do less of it. You cut back of it. Take the loss quickly. Add to winning positions. I think that for me is the best way to trade leverage trades, CFDs especially. If you get it wrong, you get it wrong in smalls. If you get it right, you keep doing more of what's working. It's like your life. You try and do more of what's working. So silver for me now, if you're looking on the hourly chart, it's just consolidating. It's going sideways. The market has no idea what to do. But when it reveals itself, it could be very, very powerful indeed. The other factor that some people have talked about, and I want to see if it's got any credibility, is this idea about what's happening in crypto. I'm seeing a bit of selling coming through on the floors today. But if you take Ethereum, for example, we did see a bit of rotation from clients being long and looking at that crypto situation there. And obviously what we've seen, if we take Ethereum, which had the London hard fork, you've seen a very powerful move playing through from this support zone. And, we're consolidating again. We tried to make a play yesterday. We tried to make a play through 3,200 today. And again, you're just seeing supply coming to the markets. The market's a little bit unsure. Whether this is subtracting from the gold price and people are saying, we're not seeing a great deal coming from gold now. Let's take our money and let's get back into the crypto scene. Maybe there's some efficacies behind that on Monday. But you can see now that we're consolidating. If this kicks up and breaks through and closes above 3,200, especially if we take Ethereum as the poster child behind this movement, that to me is a movement market. This is a steamroller, and I wouldn't want to get in front of that. I would be looking to go long, and I would be looking to ride that train up. We've got a really strong move. It doesn't last forever. Now we're seeing that consolidation. Price is still just about holding on to that 5-day exponential moving average. If this closes back above 3,200, the momentum will take this one higher, I think, and I think they'll probably be looking to add to long positions in that situation there as well. Well, I know this is a gold webinar, and a lot of people don't like the crypto scene too much, but this is about making money, and I like the idea about trying to buy strength and sell weakness. I think it's a really great place to start if you're a CFD trader. What about good gold mining stocks? I don't look at bottom-up stories, to be honest. Yeah, I'd be scanning the market for stocks that are trading with strength, rather than actually looking at really good, interesting stories like Barrick or Newmont or Newcrest Mining or any of the gold plays, to be honest. I mean, I think if you're trading CFDs and trading short-term derivatives that are focused on this, the best thing you can do is find stocks that are having the strongest movement and align yourself to that movement. I don't like the idea of buying weakness. I like buying strength and looking to continue a continuation of that move. And so I'd be scanning the market. I don't have time necessarily to do that right now, but maybe that's something that we can look at for you. Just reach out to us on the channel, and maybe that's something that I can run a scan and on gold stocks and find out which are the strongest gold stocks at the moment. There's a few gold ETFs that we've just started offering. The gold miners, the GDX is an interesting one if you're looking for gold stocks specifically. So we can have a look at the gold miners. I mean, that doesn't look particularly great at the moment. It's probably just a reflection of what we've been seeing. But I think a break of $33 on the gold, the GDX, which is a collection of different gold stocks, that could be where you can get some diversification. But again, it's not really doing a huge amount there. If that starts rolling over, that could be a good, interesting short situation. I'll take one more question. Comment from Dean. You would think at least take out yesterday's high or into Friday's low, where a huge short came in about 4 billion. Yeah, it's a good one. Let me go back to let's go back to this situation here. A huge short came in about 4 billion. I haven't read that. I think I saw some headlines about that on Zero Hedge about the size of the short. But yeah, for me, this is the level we're looking at. So you've probably got this bit of consolidation into Friday. That was Friday's closing level that we saw. But as we saw the open there, we saw it just a few sellers kicking in, and we just saw the collapse. The rug was pulled effectively. Bang, off she goes. And then obviously we've seen this climb back up. So this for me is a really interesting one. And obviously I'm playing there. So will we see the supply kick in? Will this roll over? We've got the 5-day just above that as well. If we can break through these levels, then I think we probably squeeze a little bit higher at the moment. But we've probably flushed out a lot of that positioning, which is probably a positive situation as well. So we've seen the market now. We know the market is, I think the long positioning in the market is probably quite irrelevant given, that it's stale and there's been such a big move recently. Our own clients, in terms of gold at the moment, for what it's worth, are holding a pretty much exactly 50-50 long-short skew. They were obviously very long of gold, and they've pared that back. We've seen a few people looking to start averaging into shorts now. You can have a look at the sentiment from options. They are expecting a bigger move to the downside than to the upside. If you have a look at the economic calendar for next week, there's not a lot of data to really focus on. We've got retail sales playing through, the Fed minutes. I don't expect them to be a big driver. We are watching what's happening in bond markets. If we do see a squeeze higher in rates, then I think that could be positive for the US dollar. But we are watching that dollar. Will we see the follow through selling that we talked about on that situation there? And just to recap, for me, crypto looks quite interesting. But if we go back to that US dollar gold price, it's make or break time. This needs to reveal itself, and when we see some weakness, I'll probably look to capitalize on that. If that strength pushes through, that could be quite an interesting one. But we're in that kind of no man's land at the moment, and it needs to reveal itself. I think that's going to happen over the next 24 hours. Hopefully, some of this volatility continues, this range expansion that we've seen. So whatever your time frame, whether you're trading on 5 minutes, 10 minutes, 15 minutes, 1 hour, daily charts, range and that expansion that you're seeing is so critically important for the market there. So I hope that after that dodgy start that we saw. It's that we got there in the end. And I thank you everyone for joining us, and hopefully we're back next week with a much more smoother process. But yeah, obviously a big week ahead for gold. Let's hope we continue to see some big volatility and price reveal itself. I think that's going to create some great opportunities as well. So have a look and keep that on your radar, and continue to trade it with Pepperstone. Thanks, guys.